removes the opportunity for compounding NAV growth. So that compounding growth is so important, and I'll uh, show you an example of that here shortly. One thing to note, and I'll go into this next, is all professional traders earn a salary. This removes the whole psychological risk, or that whole scare of certainly you can be scared as a professional trader, obviously, but I think what I'm alluding to here is trading for income brings in the emotions that you have to pay the bills for what you do, and that, as I've gone over multiple times here, that just brings in the wrong type of thinking. It's all emotional. Whereas professional trader earning a salary, they're thinking logically. They're approaching the market from a logical perspective. They aren't sitting there feeling that they absolutely have to make money that particular day. So it's a very different way of looking at the market. Retail traders can earn a salary from their trading if approached correctly, and I'll show you that here shortly. So fee-based professional investment management is, what it does is it takes asset allocation and risk management as a top priority. Trading serves as more of a hedge activity rather than for income, and it's really just a smaller part of a grander concept of managing assets. Professional traders, as I said, earn a salary, which removes the whole behavioral finance hurdles, and they really put the NAV growth as a high priority, which means profits are reinvested within the overall target asset allocation model. Obviously they do earn a salary, and it depends on how we define professional traders, of course, and I'll walk you through that. But it's a very different way of thinking. So this is a professional investment management approach where 80 to 90% of what they're doing is more or less long-term investment management, and then the intraday trading, or the hedging, if you will, it takes up a very small percentage of time and capital. So this would represent time and capital, this whole pie chart here. But hopefully that helps you with understanding how these higher time frame traders are looking at the market. So how can retail traders earn a salary? Well, first of all, professional traders, hedge funds in this example, charge a fee for managing assets. They also charge performance-based fee, which is typically a percentage of the overall portfolio's gains. The industry standard is 2%, an asset management fee of 2%, with a 20% performance incentive fee. So many of these managers reinvest those performance fees within the portfolio, but of course they have the discretion to take that out if they want to. But the idea there is, by reinvesting that money, it really helps to grow that NAV, and of course a larger NAV provides them with the higher net asset. The higher NAV provides them with higher asset management fees. So again, that goes into the whole thinking of building a salary rather than trying to take a chunk of change out of what you're doing each time you make money. Retail traders can adopt this variation. They can look to charge their account an asset management fee, and of course a performance-based fee. They can withdraw the asset management fee on a monthly or quarterly basis, whatever makes the most sense. And of course the performance-based fee could be their bonus that they either take out or reinvest however they see fit on, say it's on a quarterly or semi or annual basis. And this obviously promotes compounding NAV growth while still being paid for your hard work. And again, use your discretion when thinking about doing this, but it's a very logical way of approaching your trading, and using it more as a business rather than a means to try and gamble to make money or whatever. So here's an example of how a retail trader could potentially structure a business like this. And keep in mind, this is not making big bucks or anything, but the idea is over the long haul to accumulate substantial assets so that you can reinvest those assets in more passive type investments, which that's another conversation entirely. But let's just go through this example quickly here. So we've got an NAV of $100,000. We decide to charge the account 2% on a quarterly basis. So that fee amounts to $2,000. That's annually, keep in mind. I mean, you can obviously change that to however you see fit, but this, just for simplicity in this example, let's just say that 2% is the annual fee, and it obviously will fluctuate with the NAV, but you can charge it on a quarterly basis, and it's obviously not a lot of money, but again, this is just an example. Let's also say that account grows by 20% for that year. So net of our asset management fee and plus our 20% gain, our NAV is now at $117,600, and our incentive fee comes to $3,920. So again, not big bucks or anything like that, but it's money to either be taken out or if you'd like, just to reinvest that money, however you see fit. But let's just assume that we took the money out, so that leaves us with the NAV of $113,680. Well, even though we took money out, we still, our new asset management fee has increased by a whopping $273. But you see, the point here is that as the NAV grows, so does your asset management fee. So again, this is keep in mind, these are just small numbers, but as I said before, you should not be trying to be trading for income, because it changes the whole dynamics of what you're doing. But at least approaching it in this way, and whatever percentage you ultimately decide to do, at least you are seeing some of the fruits of your labor here. And of course, as I said, as your account grows, so does your fee income, and as you start to make more and more money, you can redirect those assets to more passive investments. So let's just hypothetically say that you feel that at a maximum you never want your trading account to be over $500,000, and all the money you're making from that point on is being reinvested into passive investments, and you're growing that pool of assets, and you'll start to get income off of those assets rather than worrying about income off of managing the trading account. So there's so many different ways that you can structure this, but I think you get my point in that you can approach this from a professional perspective and still see, as I said, the fruits of your labor here. And the goal is to achieve substantial NAV growth, which will provide your capital to be reinvested in longer-term passive investments, as I've been talking about. Once that's achieved, the dynamics of your income stream will change to the following. So, here's our daily trading. Those short-term trading profits are then reinvested into longer-term, more passive investments, and we can manage that on a daily, weekly, monthly, or however you see fit perspective. And then the income ultimately that you'll be receiving, and this isn't like some get-rich-quick scheme or any silly thing like that. This is just trying to outline what it would look like once you get to that level. And so you'll be getting your fees from your managing of these assets, and you can also charge a fee on this, of course, or this pot. So fees, as well as any sort of passive income you get out of this, and to whatever you see fit, of course. So it provides you with a very diverse income stream, and it completely, well, I won't say completely, but it drastically removes the whole emotional aspect of trading. So let's now just go over, as I was talking about, how we can see the difference between compounding NAV growth versus taking a fixed amount of money out of our account each month. So the column on our left here is we're taking a fixed income out of our trading account, and the column on the right is we're simply leaving all of our profits in there to further grow and obviously help us build larger position sizing and whatnot. So The account, this is again just real hypothetical basic stuff, starting with a $50,000 trading stake here, and the first month we make 3%, which equates to $1,500. We're net even there. I should rephrase that actually. I said 1,000 fixed amount. I should say if the account makes 1,000 or more, take that out. Or if I don't make, in this column, $1,000, I still take that amount out. That's probably a better way to put it there. So anyway, back to where we were. So we made $1,500 in this column as well as this one. This column we took out that $1,500. This one we didn't. So the next month our starting account balance is $50,000 versus $5,100, or excuse me, $5,100. Excuse me, I can't talk. $51,500. Excuse me. And then for that month we actually have a bad month and we lose 5% of our account. So that's $2,500 lost on this side, $2,575 lost on this side. So that brings our starting account balance down, obviously. In addition to that, we also take $1,000 out for income in this column. So starting in the next month, we've got $46,500 to start here, with $48,925 to start here. And maybe we're a little shaken up this month, and we only make 1% back on our trading here. So $465 gained on the month. Nothing to write home about. But again, we have to take our $1,000 income here, whereas this, there's no reason to do that. Just continue to grow our NAV. So next month we start out with $45,965 versus $49,390. And we're feeling pretty good. Last month it wasn't the best, but it wasn't the worst. We made money, and we make 4% on our trading here. So that's $1,838.60 that we made. And on this side it was $1,975.60. So this side was saying, hell, great, I actually made the amount I needed to make to take out for the month, and I can even leave $800 in there. That's great. Now it's working. Whereas this, we left it in there and reinvested that money. So start the next month, we're starting with more money. It's $46,800. We're feeling great here. And on this side, we actually have more. We've now gone above our initial investment amount. Not quite above the full amount of here we go again, $51,500, but pretty close at $51,365. So we're doing good. Maybe we got a little too confident this month and we lost 5%. And again, on this side, you got to take your fixed income out at $1,000. And the overall loss before even taking money out was $2,300 and change, whereas here we lost $2,500. So it definitely hurts to lose 5% of your account in 1 month, but it does happen. So we start the next month out at $43,463 on this side, and we're down to $48,792.32 on this side. So still pretty close to what we put in it here, whereas this, we're really starting to lose our investment here. It's really being drawn down pretty significant. So but for whatever reason we do okay, and we make 2% on the month. And again, we take our fixed income out, so we take all of what we made in the month and then some on this side, whereas on this side we took out nothing. It just reinvested that $975. So good stuff there. And now at the end of 6 months, we can see how we did. So on the left side, at the end of 6 months, we have $43,332.69 versus $49,773.27. So big drawdown. We're down 13%. Whereas this side, we're down marginally, barely anything, not even a percent there. So we didn't take any income here, but we took $6,500 out of our account here. So we can see that essentially we're flat, but we're down 13% in this account simply because we had to take that fixed income out each month. So let's see how we do the next 6 months. All right, so the next month, obviously starting the same amount, we make 3% on the month, so $1,200, almost $1,300 on this side, whereas this side we make almost 1,500. So we're starting to see the change in return on that compounding growth there. So again, you know, this may be a typo here, but I don't. For some reason, I think I left that in there, but I think it's just 1,000 out. Yeah, it is just 1,000 actually. So we took 1,000 out. Sorry for that typo there. Hopefully my math is correct here. And then on this side, we don't take anything out. We made $1,500. Start of the next month, we're at nice gain in the month. So we're up a little, 43,632 versus we're now back above our initial investment amount again here, 51,266. And this month we do really well. We make 5%, and that's $2,100, almost $2,200 here. And now we're really starting to see a pull away here. We're at 2,500 here, so really nice increase in gains here, and that takes us up to a new high, count mark there. Whereas this, we're still well below our initial investment. So we took our $1,000 out. We're now at 44,800 and change versus 53,800. And this month, essentially kind of flat, but we lose 1%. Not a big amount of money, 400 here, 500 there. But again, we got to take our $1,000 fixed income out, whereas nothing here. I mean, you can obviously see where this is leading to, but I'll keep going. Now we're starting with less than we had before by pretty fair amount, and but this month we make 4%. We make what we need to take out again. We can leave $700 in there. 4% here. Now we're well over $2,100 on the month in earnings. That's pretty nice, and we're moving up as far as our growth goes in the NAV. So this month we took our 1,000. Now we've got 44,000. We started with more than what we had last time, but this time we made a new high amount on our account. We're up 55,000 and change. So you can see, I'll just quickly go through the last bit here, but 2%, $800 didn't make what we needed to make, so we're going to end up with less. Whereas this here, we made $1,100 and change, and we finished out the month and really just year at the high point. So still below what we put in, 44,000, whereas here we're up to 58,000. Income taken for these 6 months was 6,500. So again, this is a typo. Actually, no, I've included that there, so maybe it isn't. I apologize for the math not being precise there, but essentially you get my point here is that the account here, it did have a modest growth of around 2%, but look at the comparison here with this account. It made 17% growth with an overall 1-year return of so we're still down around 11%, whereas this account here we're up well over 16%. So not a bad year on this side, but you can see the power of compounding growth, and that's the idea there. And of course, you could figure out, well, if I made I'm still roughly where I started at, but I was also able to take out around $14,000 for income for the year. If that's what suits you, then that's certainly fine as well. I mean, the returns are the same. You can just see how the overall returns can drastically increase, and over time the idea here is this account on this side is going to get bigger a lot quicker, and we can start to redistribute that capital, as I was alluding to earlier, into more passive investments. Okay, so that pretty much is it for that. Let's just go through a quick summary here. This presentation should have provided you with the following: a new understanding of the various risks associated with trading, ways to reduce risk from a general perspective down to intricate trading concepts, and also provide you with a way to approach your overall trading from a more professional perspective. So really important to understand these concepts and not get caught up in all the common pitfalls that can occur in trading. So anyway, if you have any questions about any of this in this presentation, I've got a Q&A section on the Private Banker forum in the risk management section, And I would highly encourage you to join this forum if you haven't done so already. But if you are a member, feel free to ask any questions that you may have. And again, if you're not a member, the Private Banker Forum is really just a place for like-minded traders to share ideas and thoughts on the markets, all centered around auction market theory, and just provide your best thinking forward in a very professional environment, and a place where people like to look at equal terms and share ideas and whatnot, and it's not a place for trying to compare who's the best trader or who has the best ideas or anything like that. It's very, very professional in that sense. So if you haven't joined, please check us out at the address here, and hope to see you soon, and thank you for watching this presentation, and hopefully it's helpful for you, and I'll talk to you soon. Thank you.